Thank you for tuning in to LeadDeveloper.com, where we simplify complex property development feasibilities, investment analysis, and everything real estate. Whether you're a seasoned pro or just starting out, our Google Sheets-based feasibility suite streamlines the toughest aspects of real estate. Lead Developer Feasibility Suite is trusted by thousands in over 17 countries. Our tools cover everything from quick assessments to detailed cash flow projections and more. Sign up today at LeadDeveloper.com for unlimited free access to our expanding library of real estate tools. No credit card needed. Plus, get full support through Edge with step-by-step guidance, exclusive courses, and resources designed for your success. Turn numbers into narratives that win over investors and lenders. Join Lead Developer now.
All right, ready to dive in. Today, we're tackling capital gains tax in Australia.
Sounds good.
We've got this awesome guide from Website Name.
Oh, yeah. I saw that one.
It's got like everything, like what it is,
right,
ways to maybe pay less,
right,
even stuff like what happens when you inherit property.
Oh, wow.
By the end, you'll know how it works so you can make some good investment choices, right?
For sure.
And to help break it all down, we've got expert speaker here. They're great at making this stuff easy, even when it gets complicated.
Glad to be here. I love making these topics clear so people can make smart money moves.
So first things first, what is capital gains tax? Imagine you bought a place for, say, $500,000.
Okay.
Years later, you sell it for, $750,000. You made a profit, right? $250,000.
Right.
Well, down under, the government wants a piece of that. That's capital gains tax.
Basically, it's a tax on the profit when you sell something that went up in value. And how much you pay depends on how long you owned it before selling.
So, like, if you bought an old surfboard at a market and sold it for more a month later, that's short-term capital gains. But if you waited years for it to become like a collector's item, then sold it, that's long-term.
Exactly. And the good thing about long-term in Australia is you often get a lower tax rate. It's like a bonus for being patient with your investments.
This guide talks about a guy, John, who bought property for $500,000, held it over a year, sold it for $550,000. Since it was long-term, he gets that lower rate on his $50,000 profit.
Makes sense.
But it's not just selling property that triggers this tax.
Right. It's any CGT event.
CGT event.
Yeah, that's what they call it. And there are a lot of them.
What do you mean? Like,
We have the obvious ones. Selling, transferring ownership, even giving a valuable gift.
Uh-huh.
But then there are some that might surprise you.
Okay, give me an example. What's one of those?
Well, creating a trust over a CGT asset is one. So even if you haven't sold anything, just putting an asset like that property into a trust can have tax stuff happen.
Whoa, really? That's wild. So why would someone even use a trust, and how does the whole trust thing mess with capital gains tax?
Trusts are often used to protect assets or for estate planning. They can sometimes be good for taxes, but they come with their own rules, their own complexities. How they affect your capital gains tax depends on how the trust is set up and what assets are in it. It can get complicated fast, so it's good to talk to a financial advisor.
Yeah, for sure. Okay, so we've got these CGT events waiting to trigger a tax bill. But how do we even calculate the tax? Is there some magic formula?
Not really magic, but there are different methods depending on your situation. The guide breaks it down to 3: the CGT discount method, the indexation method, and the basic method. Choosing the right one can make a big difference in how much you pay, so it's good to look at each one.
Let's start with the simplest one, the CGT discount method. Is that the one most people use?
It is. It's for assets you've held for more than 12 months. And it basically cuts your capital gain in half for individuals, or by a third for complying super funds and life insurance companies. So you're only taxed on part of the profit. Remember, John and his $50,000 profit. With this method, he'd only be taxed on $25,000. That's a pretty nice discount.
That is a nice discount. What about the indexation method? When does that one come up?
This one is specifically for assets you got before September 21, 1999, and held for at least 12 months. It takes into account how inflation has changed the asset's value over time.
So it factors in that $1 today isn't worth the same as $1 back then? Makes sense?
Exactly. It can be a bit more complex to calculate, but it can be really good, especially if you've held on to something for a long time.
Okay, so we have discount and indexation. What about the basic method? How is that different?
The basic method is used when you've held an asset for less than 12 months. It's like the default, no discounts. You calculate your capital gain by taking the selling price and subtracting the asset's total cost base. That includes the purchase price and any expenses. It's straightforward, but the whole capital gain is taxed.
No fancy discounts or inflation adjustments with this one.
Got it. Now, before we get too deep into numbers, let's talk about something good. Offsetting gains with losses. How does that work?
Absolutely. Let's say you made some capital gains,
Okay.
but you also had some investments that, well, didn't do so well. You ended up with capital losses. You can actually use those losses to offset your gains, which can lower your overall tax.
So if I made, say, $10,000 on one thing but lost $5,000 on another, I'd only pay tax on the $5,000.
Basically, yeah. But there are specific rules about which losses you can offset and when.
Like what? Tell me more.
One thing to remember, you can only offset capital losses against capital gains. You can't use them for your regular income. Okay, what about like personal stuff? If I sold my old car at a loss, can I use that to offset gains on an investment property?
Unfortunately, no. Losses from things you use personally, like that car, usually aren't eligible. Same goes for assets that are exempt from CGT in the first place. And there are special rules for things like leased properties in certain businesses.
Got it. It's not JST adding up wins and losses then, but it's a strategy worth looking into. Now, I know this is your area, so what are some common misconceptions about this offsetting thing? Anything we should clear up?
One big one is that you can carry forward losses forever to offset future gains. You can carry them forward, but there are sometimes limits.
It's not a get-out-of-jail-free card then.
Exactly. It's always best to check the current rules and make sure you're doing it right.
Good advice. Okay, I think we've laid some good groundwork. We know what capital gains tax is, learned about those CGT events, and even found some ways to maybe pay less tax. Now let's get into some real-life situations our listeners might face. Let's start with investment property. Always a hot topic down under. Ready to jump in.
Yeah, let's do it. So with investment property, that CGT alarm bell rings when you actually sign a contract to sell it. Even if you don't finalize everything until later, for taxes, you've already disposed of it.
So even if I don't have the cash yet, the tax folks are already looking at my gains.
Pretty much, yeah. It all goes by the financial year you sold it in. That's why it's super important to keep good records of everything you do with the property for at least 5 years after that CGT event happens. Those records can be really helpful, especially if you end up with a capital loss, because you can use that loss later to maybe offset future gains.
Smart move. Speaking of investment properties, the guide mentions this couple, William and Isla, who have 2 homes. How does capital gains tax work when you have 2 places? Can they get that main residence exemption for both?
That main residence exemption, it can get tricky sometimes. Usually the place you live in most of the time, your main home, that's exempt from CGT. But if a couple owns 2 and lives in both, they got to pick one as their main residence for tax purposes.
So no double dipping on the exemption?
Not usually. If they both agree on one as their main home, they both get a full exemption on their share of that property. But if they each want to pick a different one, it gets more complicated. The person who owns 50% or less of their chosen property, they get a full exemption on their share. But the one who owns more than 50%, they might only get a 50% exemption for the time they had different main residences.
Okay, so it's not always straightforward. Definitely sounds like getting advice from an expert would be a good idea in those cases. All right, let's switch gears to inheriting property. Lots of people have questions about this. If you inherit a place, does that automatically trigger a capital gains tax event?
It's a common thought, but inheriting property itself isn't a CGT event. So no, you don't get a tax bill the moment you inherit it.
That's good to know. So when does capital gains tax actually apply with inherited property?
It could apply later on if you decide to sell the property. Several things matter, like when the person who passed away originally got the property, when they died, were they an Australian citizen then? How was the property used while they owned it? And even your citizenship when you sell it. Lots of variables.
No easy answers there then, lots to consider.
There is. But good news, there might be a CGT exemption for inherited property. If it includes a dwelling and you sell it all together, you might not have to pay CGT.
Okay, that's helpful. Now, for those who like to get a little strategic with their investments, the guide also talks about ways to maybe reduce your capital gains tax. One that stood out was using a self-managed super fund, or SMSF, to buy property. Is that as good as it sounds?
It can be, but just like anything you invest in, there are good things and risky things to think about. Using an SMSF to buy property can be a really smart move for the long term to help you pay less capital gains tax later.
Walk me through it. How does that work?
Well, if you sell the property after you retire, you might not have to pay any capital gains tax on it at all. And you could also get that 33% discount from the CGT discount method we were talking about earlier. 2 birds, 1 stone.
Sounds great. But what are those risks you mentioned? What are the downsides?
Well, loans for SMSF properties, they often have higher interest rates than regular loans. Got to keep that in mind. You also need enough cash flow within your SMSF to make the loan payments and cover other expenses.
And I'm guessing there's some tax stuff to watch out for too, right? It can't all be easy, can it?
Right. You can't just use tax losses from your SMSF to offset income you made outside of it. And there are rules about making changes to the property until you pay off the loan.
Sounds like it's not a decision to rush into. Probably a good idea to talk to a financial advisor. Any other strategies the guide mentions for minimizing capital gains tax besides the SMSF thing?
One easy one that people sometimes forget is to actually live in the property yourself as your main home for at least 12 months before you sell it. Remember, your main home is usually exempt from CGT. So if you turn an investment property back into your home for a bit, you could avoid a big tax bill.
Oh, clever. Using that main residence exemption to your advantage. But I'm guessing there are rules about that, right? You can't just move in for a weekend and call it good.
Yeah, exactly. To qualify for that main residence exemption, the place has to have a dwelling on it. And you actually have to have lived there as your primary residence. You can't trick the system. They're pretty good at figuring that out.
So no funny business. Got it. Okay, we've covered investment properties, main residence exemption, inheriting property. What about vacant land? Does that get hit with capital gains tax too?
It does. People don't always think about it, but vacant land is a capital asset, just like a house. So it's subject to CGT. And here's where it gets interesting. Things like splitting the land up or combining titles, those can affect your CGT.
So even doing something seemingly simple with vacant land can have tax consequences.
For sure. It's a good reminder to always think about the potential CGT stuff with an NY property transaction, even if it seems really straightforward.
Great advice. Okay, I think we've covered a lot. We know about those CGT events, different ways to calculate gains, and even some strategies to potentially pay less tax. Before we wrap up, any final thoughts for our listeners? What's the key takeaway from all of this?
Yeah. You know, going through all this, it really makes you realize how much capital gains tax is tied to the whole economy and what the government does.
Yeah, totally.
It's not just about the numbers on your tax forms. It's about how these rules change how people invest and how it impacts what the government gets.
It's like if the government makes capital gains tax rules that are, I don't know, more favorable for certain investments,
Right.
it can steer investors that way, right? Like, hey, we want you to put your money here.
Exactly. It's like a nudge from the government. Yeah. And that can change the whole investment landscape. It's not just about people saving money on their taxes. It's the government trying to, direct where money goes in the economy.
That makes sense. And that capital gains tax money, it's not just vanishing. It's paying for important stuff, services, infrastructure, stuff that we all benefit from.
For sure.
It's like we're all part of this big system, right?
Yeah.
We're not just watching from the sidelines. We need to understand these rules and make good choices that work for our goals and what we believe in.
Absolutely. And this deep dive has given everyone listening a solid base to do just that. You learned about those CGT events, how to calculate your gains, even some ways to maybe lower your tax.
Yeah, we've only scratched the surface, but now you can navigate this whole capital gains tax thing in Australia with more, confidence.
And remember, that guide you guys shared, it's a really good resource. Check it out on website name for more info and examples. They even have some tools and calculators, all free, that can be super helpful.
That's awesome. Well, thanks so much for being here and sharing your knowledge, making this complex stuff easier to understand. I learned a ton today.
Happy to do it. Always glad to make these topics clear and help people feel more in control of their money.
And to everyone listening, happy investing. May your capital gains be big and your tax bills small. Remember, knowledge is power, and now you've got the power to make some smart decisions about your property investments in Australia.